Which free cash flow ETF is the best? COWZ, VFLO, FLOW, or DSTL? This is Ethan, CFA Charterholder and investment professional, and today I'll be comparing them to help you decide which one, if any, is right for your portfolio. Let's dive in. We'll start with COWZ, since it's by far the most popular. We just released a deep dive on it, so in this video, we'll just start with a quick 1-minute overview of free cash flow and free cash flow yield to make sure we're all on the same page. And then the quick COWZ highlights as a baseline to compare the other funds to. Feel free to skip ahead a minute if you know all these terms and just want to get to the comparison. Free cash flow basically measures the amount of cash a company has left over to do whatever they want with after they pay their essential expenses like taxes, interest on their debt, inventory, and equipment purchases that they can't really avoid if they want to remain a viable business. It's broadly considered to be the best metric to use to value companies on. Well, other than for banks, it doesn't really work for banks. But for most companies, it's considered to be better than earnings, better than sales, better than book value, in part because it can't be as easily manipulated by the company as the other metrics. Free cash flow yield is just a valuation metric based on free cash flow. It's basically a measure of the percentage of a company's value that they're free to do what they want with, like invest in growth or pay dividends. And that's the key differentiator between dividend-focused funds and free cash flow-focused funds. Dividend funds focus on the yields that companies are actually paying out. Free cash flow funds focus on the yield that they could pay out. That brings us to our first ETF, COWZ. COWZ is basically the top 100 U.S. companies with the highest free cash flow yield, weighted by the trailing 12-month free cash flow, with holdings capped at 2%, and the portfolio reconstituted and rebalanced quarterly, meaning each quarter they run these screens again and then sell what they need to sell and buy what they need to buy to get in line with the new portfolio that the computers are telling them to buy. Its approach has resulted in a portfolio that's been consistently oriented towards small cap, value-oriented, dividend-paying companies, which has led to strong results and a very differentiated return pattern compared to the S&P 500. We'll continue talking more about COWZ throughout the video as we get deeper into the other funds, but I think that's all we need to get us started. Next, let's talk about FLOW, which a lot of people say is the same approach as COWZ, just cheaper. One of the key knocks on COWZ is that it still costs 49 basis points. I'm the last person who would say cheaper is always better. Sometimes you get what you pay for, but this is a $25 billion passively managed ETF that's run by a computer and only rebalanced quarterly. There is no excuse for it being so expensive, in my opinion. FLOWZ proves that, coming in at just 25 basis points for a strategy that's actually not exactly the same, but it is dang close. COWZ and FLOW currently have 84% overlap in their holdings. There are minor differences not worth covering, like they use a different starting set of the largest 1,000 U.S. companies, but in most key ways, they're essentially the same. They hold the same amount of companies, selected based on the same criteria, weighted based on the same criteria, with the same 2% cap on the size of each individual holding, reconstituted and rebalanced at the same quarterly frequency, and they both exclude financials, since free cash flow doesn't work well for financials. The one key difference is that FLOW has a 25% sector cap, whereas COWZ does not. We showed this chart in our prior video. You can see how COWZ's energy exposure reached over 35% of its portfolio in 2023, after oil prices hit their highest point since 2008 in June 2022. That's a risk with any backward-looking screening ETF, but it's less of a risk with FLOW than it is with COWZ, since they have a 25% cap on their sector exposure. For me, I think that's an advantage, along with the cost, so I would prefer FLOW over COWZ myself, but for you, it may be different. If you just really want the purest form of the free cash flow screen, that's what COWZ offers. FLOW hasn't been around long enough for us to really compare, but I'd expect it to have slightly less extreme results. Not as good in good times, and not as bad in bad times. The one knock on FLOW, relative to COWZ, might be its asset size. At only $8 million, it's probably not profitable for Global X to run it. So if they can't gather more assets, then at some point they may close it down. That doesn't mean you'd lose your money. It just means you might be forced to redeploy it into something else, and there might be tax implications depending on how long you held it and whether you had gains. It's a small risk in my opinion, but it's worth mentioning. Next, let's turn our focus to VFLO. the Victory Shares Free Cash Flow ETF, which a few people have already told me they think is better than COWZ and FLOW. So let's dive in and see. It comes in at 39 basis points, which is less than COWZ, but more than FLOW. And another notable difference is that it's focused on larger companies. VFLO does attempt to improve upon the approach of COWZ and FLOW in two ways. They start with a trailing 12-month free cash flow, so similar, but then they also consider the expected free cash flow, as in the projected free cash flow over the next 12 months. According to their backtesting, incorporating expected free cash flow in addition to trailing free cash flow would have boosted performance. You always have to take backtests with a grain of salt, but I don't see any reason to believe that this wouldn't continue working in the future. When people look at the PE ratio, or price to earnings, for example, it's almost always using the forward PE, meaning the current price over the consensus estimates of the company's next year's earnings. This is just basically doing the same thing with free cash flow. The second way they try to improve upon the process is by incorporating a growth filter that eliminates the companies with the slowest projected growth. According to their backtested research, they show that eliminating the bottom one-third of companies based on growth projections would have further enhanced returns from just focusing on trailing and expected free cash flow yield. More specifically, here's how they build the portfolio. They start with the VettaFi U.S. Equity Large Mid-Cap 1000 Index, which is an index of the largest 1,000 U.S. stocks, very similar to what COWZ and FLOW are using. Next, they select the 75 highest free cash flow yielding stocks based on a combination of their trailing and expected free cash flow yields. Of those, they select the top 50 with the highest growth score, aka the top 2/3, consistent with what they did with their backtesting. They don't really tell you how they come up with their growth score, other than it's based on the company's growth metrics like sales and earnings trends, and that it's selected by the index provider, VettaFi. Once they have their list down to 50, they weight the stocks by using the score based on free cash flow and free cash flow yield, which they don't really go into detail about even in their prospectus. Holdings are capped at 4% instead of 2% like COWZ and FLOW, and their sector exposure is capped at the lower of 45% or 20% higher than the broad market index they started with. Translation, it can get pretty concentrated. I do have a personal preference for this approach over COWZ and FLOW because I think the forward cash flow and growth projections are sensible to include. Are they guaranteed to be right? No, of course not. But remember how COWZ went to 35+% energy right after oil prices peaked and started crashing? Well, maybe the incorporation of forward-looking estimates can help avoid that. It hasn't been around for very long for us to know for sure, but conceptually, this sounds like a better approach to me. And that brings us to our final ETF, DSTL, the Distillate U.S. Fundamental Stability and Value ETF. Hopefully they're better at managing ETFs than they are at naming them. That is definitely a mouthful. This one comes in at 39 basis points, the same cost as VFLO, and it also sits in the large value category, the same as VFLO, so a little larger company focus compared to COWZ and FLOW. It's also the second oldest of the ones we're looking at today, with an inception in October 2018, which will come in handy for results comparisons here in a couple minutes. The STL is another one that tries to improve upon the more simplistic approach of COWZ and FLOW. It does that by combining quality factors like stable cash flows and low leverage with value factors, which are largely based on free cash flow. It starts with a list of about 500 U.S. stocks that meet their criteria for profitability, historical cash flows, and liquidity. Then, they narrow the list down to the 100 most attractively valued companies based on each company's normalized free cash flow yield and the volatility of their historical and projected cash flows. Normalized free cash flow yield is just a free cash flow yield adjusted to account for non-recurring items, aka one-offs that aren't expected to repeat in the future. And from the quality perspective, they also consider balance sheet quality and don't invest in companies with too much leverage. Although I'm not sure how often companies with tons of debt would ever be among those with the highest free cash flow yields anyway. Just like the others, it's rebalanced quarterly. If we look at their factor profiles, which show the current exposure with the blue dots and historical exposure with the light blue shaded areas, we can see how these ETFs' exposures compare. The first observation I'll make is that they're all broadly similar, as you probably expected. If they were all wildly different, there would be no point in us making this video. One differentiator I did notice with DSTL is that compared to the others, it's had a slightly lower volatility profile. That likely has to do with its metrics to consider quality and stability of cash flows rather than the more simplistic and narrowly focused metrics of the other ETFs. DSTL and VFLO also both have a little less of an emphasis on small companies, which I already sort of mentioned when I highlighted that they were in the large cap category, while COWZ and FLOW were not. The STL and FLOW also are both a little higher on the quality spectrum. Again, no surprise given their added focuses on metrics that they hope will indicate sustainability of free cash flow, as opposed to just looking at how high it is. The STL and VFLO have also been slightly less value-oriented, especially DSTL, which makes sense given their approaches. We're splitting hairs here a bit, as all of these are mainly focused on high free cash flow yielding companies and thus broadly biased towards smaller, cheaper companies. Results are hard to compare since VFLO and FLOW have such short track records, but I'll do my best. Let's start with DSTL and COWZ since they have the longest track records, and I'll put VOO in there in green for comparison. We'll add the others in a minute. I think it'll be easier to show you what I see when I look at this chart if we go section by section. Starting with 2019 up until the crash, you can see that was generally a weaker period for the more pure free cash flow metric. DSTL was able to keep pace and actually beat the S&P 500 slightly, while COWZ really fell behind. COWZ also did a little worse in the downturn, while DSTL beat the S&P 500 by a little, although none of them really looked like something you'd expect to be highly protective on the downside. Remember, though, this was a very unique downturn where a lot of high-growth, sometimes not even profitable tech companies did really well. If your business was digital, you probably crushed it. And at the same time, a lot of traditionally more stable businesses were totally shut down. So this is worth considering, but also probably should be taken with a grain of salt. Nevertheless, I think when comparing DSTL versus COWZ, I would expect DSTL to protect better on the downside in most downturns and just have fewer extremes in general, good and bad, which we'll see here in a second. Not much changed in the initial recovery, but in 2021 and 2022, as rates and inflation picked up, and especially in early 2022 when energy prices started roaring, COWZ came back strong. ESTL also significantly outpaced the more large-cap, tech-heavy S&P, but COWZ did even better. Again, like I said, more extreme in both good and bad times is what I would generally expect from COWZ. Now, if we bring in VFLO in light blue, which has only been around since June 2023, we can see it's actually beaten everything since its inception, even the S&P, at a time when other free cash flow ETFs like COWZ and DSTL have fallen behind. And that's still the case if we fast forward to FLOW's inception in July and add in that one here in purple. I'd consider COWZ if I wanted the purest focus on free cash flow and free cash flow yield with the fewest limitations or other considerations to deviate from that mission. As long as you're okay with the extremes and the higher costs, it would be the best approach for that. I'd consider FLOW if I wanted that approach, but they didn't want quite as many extremes since it's got the 25% sector cap, and I'd also consider it if I wanted the one with the lowest cost, which is just 25 basis points for FLOW. I'd consider VFLO if I believe that their back-tested results of adding the expected free cash flow and the growth estimates would enhance returns in the future. For the record, I do believe that, although not really with a high degree of confidence. I've seen too many really compelling backtests fail to work once they were implemented to be a strong believer in any of them, but it sounds totally logical, and I don't really have any reason to believe that it wouldn't work. I consider DSTL if I liked their broader approach. It's still free cash flow heavy, as in that's arguably the most important component of it, but there's more to DSTL's approach than any of the other three, with its quality and consistency focused metrics. DSTL also has the best track record of the two that have been around longer than 2 years, which doesn't necessarily mean that it'll do better in the future, but it's certainly worth considering. If you enjoyed this video, hit that like button, leave us a comment with what you'd like us to cover next, and subscribe so you won't miss it. And if you'd like to connect with my partner Kyle and I directly, you can do so by joining our Discord through the link in the description.